Up next on the SRI 360 podcast.
For me, ESG and sustainability are two different things. We have an investment strategy which is sustainability, resource efficiency, pollution control, but ESG is not part of the investment strategy. We will never ditch an investment because it scores low on ESG. If a business model is not sustainable, there is nothing you can do. It means nothing to have a responsible investment policy. The trick is in the details. You should ask me, what the hell do you do with this policy? According to our placement agents, we are a top decile fund in terms of returns. It proves the market that to pursue an environmental positive thesis, it doesn't mean you have to compromise on return expectations.
The SRI 360 podcast, presenting world-class investors and experts, passionate about improving the world and making high-performance returns through unique ESG, impact, and socially responsible investments. Here's your host, Scott Arnell.
Hey everyone, in this episode I am visiting with Stefano Bacci, and that's spelled B-A-C-C-I, just like the ball. And Stefano is a partner at the private equity firm Ambienta and is Ambienta's ESG Manager based in London. Stefano joined Ambienta in 2012 and has been involved in a number of transactions including Tower Light, Calusem, Astronaute, IP Cleaning, SF Filter, and numeric. Prior to joining Ambienta, he was a partner at Palamon Capital Partners in London for 9 years, and before that he spent 7 years at Boston Consulting Group based in the Milan, Stockholm, and Helsinki offices, where he focused on European industrial companies. He started his career at BASF in Basel, Switzerland, first in the R&D division and eventually in the stabilization of recycled plastics. Stefano graduated from Politecnico University of Milan with a degree in chemical engineering and holds MBAs from both the Helsinki School of Economics and Boston's MIT. He completed his postgraduate studies in physical chemistry at the Technische Universität Darmstadt in Germany. I really enjoyed speaking with Stefano. I walked away with a lot of new insights, and I hope you will too. And now, please meet Stefano Bacci. You don't have a strong English accent. I think you're coming from Italy.
Yeah, that's correct.
And did you grow up in Milano?
I grew up in Italy, and I left when I was 24 because I completed my university in chemical engineering in Milan. Then I went to take my PhD in Germany. Then I had my first job in research in Switzerland. Then I decided to take an MBA, which I decided to take in Finland. But then I got in touch with a lot of exchange visiting professors from MIT. So I managed to transfer to MIT. And then I had 10 years of the Boston Consulting Group, which, of course, when I was in Boston, I met the Boston Consulting Group. They moved me to Milan. Then after a year in Milan, they transferred me to Stockholm. After a year in Stockholm, they transferred me to Helsinki because of the MBA and the connections. And then I spent 10 years with the Boston Consulting Group. Then eventually I decided I wanted to be an investor. So I started with Palamon Capital Partners. It's back in year 2000. And then I moved to Ambienta about 10 years ago, a bit more than 10 years ago.
Where in Italy are you from?
Well, culturally, I'm from Tuscany, but I really studied and grew up in Milan. As I told you, I left when I was 24, and now I'm 60, so it's a number of years ago.
Your first degree was in chemical engineering. What was the idea at that time?
My dad was an industrial chemist. My mom was an organic chemist. So at home, every dinner, all they spoke about was chemistry. So very young, I grew with this passion for chemistry. One day I said to my mom and my dad, I also want to study chemistry. And they said, what? Don't you dare. You want to be unemployed for life? And I said, no, I would like to have a job. Then stay away from chemistry. And then I said, okay, then physics. They said, no way, no physics. Do you want to spend all your life in a lab? You want to make some money? I said, well, I would like to make some money. And then be an engineer. And so I landed on chemical engineering.
I lost the sequence. You went to Politecnico in Milano, right, for chemical engineering. But from there, you went to BASF.
No, from there, because I did my thesis work with the Dutch professor who put me in touch with a German professor in Darmstadt. We did some things together. And then after I finished my thesis, he said, why don't you come over in my research group and you do a PhD? And so I did. I transferred to Darmstadt and I worked for, I think, a year and a half in his research team. I had this passion for physics, so I went into physical chemistry rather than chemical engineering with him. And then he told me, well, there is Ciba-Geigy, at the time was called, in Switzerland. They are expanding their research. They look for a person with your skills that can help them in numerical modeling would be a postdoc contract. It was very well paid, and I went. And so I spent 5 years in Switzerland, in Ciba-Geigy. Now I think it has been unwound. I think the unit where I was working has been sold to BASF, and that's where BASF comes in.
That was true chemical engineering. You were definitely in the engineering side at that point.
I was in numeric modeling calculations, I think they used to call that branch of physics.
And then it was after you left there that you got your MBA, is that right?
Correct.
And what was your idea? Like you decided, okay, I want to get on the business side, or
it's a funny story now. I don't know what you're going to do with this information, but it'd probably be too funny. But basically, I joined Ciba-Geigy and I had an induction course together with a number of other young graduates that were recruited in the same month as me. And, you remain in touch. And after 5 years of research, one day I am in the canteen and there is the Ciba-Geigy news bulletin. So I check and I see a friend of mine just being promoted chairman of Ciba-Geigy Brazil. So I call him up and I say, chairman, you started together with me. I'm still at level minus 150 down in the cellar of the pyramid. And you are chairman. And he said, yeah, come on, with this science and R&D, get yourself an MBA and you'll make some money. And I thought about this and I said, okay, I'm going to do this. And so I did. I remember I went to the Divisionsleiter. He said, would you sponsor for me an MBA? The guy was German, but he spoke a very funny Italian with a very accomplished, but with a very strong German accent. He told me, you know why this company is so strong? And I said, question. No, I don't know. Because we don't have these troublemakers of MBAs. We are all chemists in this company, and that's why we are doing well. I'm not sponsoring you for an MBA. And I said, okay, then I resigned.
So then you went to Boston at MIT to...
No, I went first in Finland. I studied in Finland for a year. The faculty there was a visiting faculty. Part was a resident faculty. Part was a visiting faculty. I took, I think, 6 courses with professors that were visiting from MIT. I fell in love with the concept, the school, and I organized an exchange and I went there.
So it's quite eclectic education. Italy, Germany, Finland. Very
I traveled a lot.
So then you went to BCG. What were you doing there?
Well, MIT, not engineering, MIT management school. So pretty much people were dividing into groups, those that wanted to go in investment banking and those that wanted to go into consulting. And I thought I was more suited for a consulting career than an investment banking career. And I still think that was the right decision. I applied for the Boston Consulting Group. They recruited me in Boston. Then they figured out that I had a sort of partial American education, fluent English, but Italian. They said, we have an office in Milan that is so short of people like you. Go there immediately. And I did. And I worked in Milan only 1 year. I found it quite hard, to tell you the truth. So there was, if you were doing well, there was it was called the ambassador program. It was a settlement program where you could ask to be transferred in another office. And I landed into Stockholm. Once in Stockholm, I spent a year there. Then I had Finnish connections, and BCG was ready to open an office in Helsinki. So they asked me if I wanted to go there, and I said yes. So I arrived in Helsinki. There was myself, a French guy, and 2 real Finns. And out of 4, I think in a couple of years, we had an office of 30 people. So that was an extremely exciting moment of my life, for my entrepreneurial spirit. And then I was recalled in Germany and worked for a number of years in Germany. Until then, I think it was the dot-com bubble, or was starting the dot-com bubble, so it was called, in the year 2000. And I decided to become an investor because I was a bit frustrated, especially in this German experience, to continuously whisper to directors what they should be doing. And I thought, why don't I find a way to buy companies and do what I want to do rather than trying to convince some lethargic director, totally risk averse, to do certain things that they feel uncomfortable with. And I think that was, again, the right decision, because then in private equity, I've always been more of an EBITDA man than a superstar deal maker. I mean, my skill is really, give me a company and I will improve the EBITDA.
So at BCG, what kind of consulting were you doing then? Was it all M&A kind of things? Or
No, never actually. I was industrial goods for about 50% of my time, and the other 50% of my time was pharmaceuticals, because BCG sort of never understood that, yes, I worked in Ciba-Geigy, but not in pharmaceuticals. I was in R&D.
You couldn't get rid of the name.
So from the first day I arrived, they told me, a pharma guy. So every pharma project, I was stuffed on it.
So then you transitioned into Palamon. And it seems like you must have got there shortly after it was founded, right?
Correct.
And then you got there just in time for the dot-com meltdown to go into investing. That was a great introduction.
No, but we didn't have issues because we didn't really have any dot-com. So we didn't have issues with the dot-com meltdown.
But it was a bit hard time to be raising funds.
But I probably entered just a tad later. So the valuations were already so much inflated that we never really ventured into any dot-com. So when the bubble burst, eventually, of course, there was repercussions for everybody and everywhere, especially on the debt side of the story. From leverage multiples of 8-9 times EBITDA, you precipitated to either nothing or 2 times EBITDA.
What were you investing in, or what was your focus?
You're right. When I started, it was very small. I don't remember. We were 4 or 5. And my focus was mainly on Italy. Palamon had an opportunistic strategy in Italy. Palamon was a spin-off of Warburg Pincus. So the 2 founders, 2 American gentlemen, were 2 partners of Warburg Pincus that spun off and created Palamon. I really think my role was a cultural interface because they had this desire to invest in Italy, but I recognized that coming from America, jumping into Italy and understand what's going on is, I had to very often debrief after every meeting we had with Italian either bankers or investee companies or whatever, and try to rationalize what was really said and what was really meant. And it worked very well because until I left Italy, in terms of returns and in terms of deployment, was the first country for Palamon. So we did well in Italy.
And then what led you to jump to Ambienta?
Then Palamon, I don't know how to define it, but it lost a few partners along the way. It started to find it more difficult to raise money. 2008 arrived. Palamon was overexposed to the financial sector. We had a lot of lending businesses. And if you remember, the credit crunch, lending was not really a popular business in those years. It was very difficult. Our portfolio shrunk enormously, despite they were all good businesses. In fact, nothing really collapsed. They all recovered and they all got sold for good values. But we had a freeze of a number of years in the middle. So I had personal issues that require my presence in Italy. So I parted from Palamon and went in Italy. Once in Italy, I met Ambienta, Nino Tronchetti Provera, who is the founder of Ambienta, got in touch, and in May 2012, I started.
Different investors who are focused on sustainability got there in different ways. Some amazingly seem to know they want to do that when they were 8 years old, and other people who were mid-career decided they wanted to do something more meaningful, and yet others arrive at it in a serendipitous way. What was your personal journey into sustainability? Personal
journey, because it is also interesting to see Ambienta's journey. My personal journey was being a chemical engineer. I worked in research, and in particular, when I was working for Ciba-Geigy, I was in projects about stabilizers. And stabilizers for polyolefins is all about recycling plastics. So I was a witness of the first steps into recycling plastics. That was not at all trivial. It's not trivial even now, 30 years later, because recycling plastic remains challenging, even more challenging 30 years ago at the beginning of the story. So somehow recycling and the fact that plastic is something that lasts forever until you find a way to meaningfully recycle it by creating other plastic products or creating other plastic compounds or releasing the energy contains whatever. It is man-made and it needs to be managed because naturally it stays there for thousands of years, right? Especially if you put it in a landfill, it will never decompose. So that was very clear in my mind. Though when I started with Palamon, we didn't really have anything of this. When I met Nino Tronchetti, the founder of Ambienta, the first time, because we met a number of times, and he was telling me about his journey personally, together with another gentleman in Italy whom I used to know, Mr. Rolando Poli, who used to be the CEO of McKinsey Italy, and BCG and McKinsey always know each other. So I was very impressed by his back in this venture, because it was really at the beginning, Ambienta, I think, was officially starting in 2007. The first fund was a 2008 fund. I met them in 2011 and starting in 2012. So it was still a very young firm. Again, we were a few guys, not that many. And Nino was telling me this is going to become more and more a pivotal element of the economy, of every growth. We cannot continue misusing resources to the extent we do. The world is exploding. I'm 60. When I did my primary school, I think I may have learned that the globe had 5 billion people living in it. Now we are almost 8. So we cannot keep misusing resources at the same rate and growing population at the same rate and growing the part of the population that actually can misuse resources, because that is the bulk of the explosion. Because the middle class, that is where really there is waste, grew over proportionally in respect to the total population growth. So it was easy for him to convince me. I had seen in my BCG years, for example, in Germany, a number of overly engineered German technologies that were out of the money and nobody really wanted. At the time, I was seeing those technologies. But if you look at them with an eye of price of resources, of natural resources being grown of a factor tenfold, then you figure out, you understand, those over-engineered technologies are not out of the money, actually are in demand, and they're going to be more and more in demand. Right? So it was easy for him to convince me into this journey, because I had all the elements to put together the story by myself.
So he painted the picture for you. You saw that, and then you dug into it. Wasn't the other way around. It wasn't that you sought them out because of sustainability.
No.
Yeah.
Nino, I think, was already very much convinced on this. He had done his thesis on sustainability. Now I don't remember what, but somehow in the field. In McKinsey, he had created a practice for sustainability. Rolando had the passion for sustainability. And he had done something, I don't remember what now, it's many years ago, but he had done some venture in sustainability. They were very credible, and they had understood that sustainability is not really flower power, but sustainability is to make sure you channel money into models that thrive because of sustainability, because they have a positive contribution, not in terms of having invented the latest technology that will change the world, because no single technology is going to really change the world. Into too early ventures, the mortality of your investments is too high to really make a lot of money. But we said, let's go chase marginal improvement. Everything can be done better in terms of energy efficiency and pollution control, which is what we do. Let's start chasing the marginal improvement and put money into the marginal improvement, because a concern we had is if you lose all the capital that your investors give you, you don't make a favor to the cause of environmentally sustainable evolution, because you're not going to get funded again and you're going to get stopped. So we said, better to be more cautious, better to maybe return less, but return and prove that the money really went into environmental sustainability. And in fact, we had to develop a numerical methodology, which we still use today internally, but also externally. We share it with investors. We call it environmental impact analysis, which is a methodology in order to assess the environmental impact of everything we invest into, or actually everything we look at. Because if there is no environmental impact, then we don't want to waste even a minute looking at it. And then we share the environmental impact of all our portfolio and all our new investments with our investors, so that they know that the money really went into an environmental cause.
Maybe can you give me a high-level overview of Ambienta, what it's doing, what the mission is, your macro focus, and an introduction to your funds and your structures, the capital deployed. And at this point, if you could just paint the big picture. I think what I want to drill down on today is the private equity piece, because I know you have public equities, but first paint the whole picture and then we'll get maybe more specific on that.
Okay. So Ambienta is a purpose-built asset manager to pursue environmental sustainability. And more specifically, is two theses that we are pursuing across industrial sectors or economic sectors, which are resource efficiency and pollution control. So resource efficiency is to invest into models where you use resources, man-made or natural, more efficiently, reduce pollution, less pollutants, cleaning water, cleaning air, reducing waste, reducing landfill, all that. pollution control, resource efficiency. This was the thesis around which the GP was built, and it raised its first fund back in 2008. Was a 217 million, I'm rounding the numbers, euros fund. Then in 2013, we raised Ambienta 2. There was, I think, 323 millions. Then we raised in 2018 Ambienta 3, which was 635 million, which is currently still investing, plus some co-investment vehicle. So that brings the raised amount in private equity, these numbers are in euro, to 1.2 billion, which makes us the largest in Europe, entirely and only dedicated to environmental sustainability. We do nothing else than environmental sustainability from the beginning. The funds share the same investment strategy, Ambienta 1, 2, and 3. So we didn't sort of invented it along the way, but we had a view at the very beginning, and we keep pursuing that view. And then we had public equity, as you correctly said, that started about a year and a half ago. So it's fairly new.
Why did you feel drawn to get into that?
The reason is to leverage our assets better, because in order to really understand sustainability, we needed to create an internal research capability. Now, this research capability is actually quite chunky. We have a team of 6 highly qualified individuals. All the individuals are engineers and have an MBA, but they don't do deals. So from a P&L perspective, our own P&L as a GP, they're a cost center, right? Because they don't bring any revenues. So already in the past, we used to sell some environmental advisory service to other public managers. I cannot name them, but we served 2 or 3 of them. And then the group, as I said, grew to 6. And then we said, such a knowledge, if you have a minute or some interest, I will tell you what they do. This team said such a knowledge can serve more asset classes than just private equity. So we said, why didn't you start to enter public equity, leveraging that knowledge and creating, again, a very specific product. We created a long-short strategy, and the product is called Ambienta X. It's quite recent. It's 18 months old.
On the private equity side, what do you benchmark against, or what's your target return?
I think the target return, I think the entire market probably is going to give you the same number, which is usually an IRR of near 30%. But now the real question is how many can really deliver it. And many LPs in the world publish the return of the funds where they invested. I'm sure you've seen those returns. To a certain extent, those numbers are public, though contractually by agreement with the investors are secret. So I can't tell you. You've got to go and find the public ones. But I can tell you that according to our placement agents, we are a top decile fund in terms of returns. Our Ambienta 2, which has closed the investment period and is almost entirely divested, and Ambienta 3, which is the current program, is probably going to be at the same level of returns. And I think that's interesting because it proves the market that to pursue an environmental positive thesis, it doesn't mean you have to compromise on return expectations. In fact, our investor space, if you look at it, you would imagine, oh, Ambienta is so green, the investors are all going to be green. No, maybe half of our investors are green labeled funds or thematic funds with some sustainability element or environmental sustainability, but the other half are just generalists that are attracted by the returns.
And just to fill out the picture, you're investing private equity in SMEs. What's roughly the target size and the ticket size you look for?
Yeah, if you look at Ambienta 3, which with investment vehicles attached, we can call it a 700 million euro program. We are looking at investments. We are looking at doing possibly 10 investments out of that fund. So that gives you an equity ticket on average of, call it 70 million, which as a range represents a range from 40 millions up to probably 100 millions as a ticket. So imagining a 50-50 debt to equity ratio, and imagine that we do majority only, it means we can chase up to a couple of 100 million of equity value, of enterprise value.
You strictly take majority control?
According to the rules of the fund, we can also do minority. But to be honest, in the journey of the one was 50-50, minorities, majorities. Ambienta 2 had less minorities. Ambienta 3 doesn't have any minority. You can very easily correlate returns with control. And where you have less control is way more volatile. Whether you can, I'm not saying you're not going to make money. Maybe you are, but it's more volatile.
How would you describe Ambienta's theory of change?
At this point, the logic in my head bifurcates because we haven't yet spoken about ESG. For me, ESG and sustainability are two different things. You can have a very good ESG management even in nuclear bombshells. But in terms of sustainability, you cannot invest in nuclear bombshells, right?
Yeah.
So we have an investment strategy, which is sustainability, resource efficiency, pollution control. We have developed a number of tools, particularly the environmental impact analysis, which is a quantitative methodology to assess the impact that guides how we invest the money into or guides how we stay away from greenwashes. There was a problem years ago, is a disaster now. And that's sustainability. Then we are incredibly active on ESG because considering the fact that as a private equity fund, we act on governance naturally. As a thematic environmentally positive fund, we are very strong on E. Then, of course, we need to deal with S, but ESG somehow is close to our strategy. So we started many, many years ago to work very actively on ESG. But ESG is not part of the investment strategy. So we will never ditch an investment because it scores low on ESG. There, the philosophy is in our 5 years, call it 5 years, we will improve whatever we get, whatever we start with. On sustainability, that's not possible. If a business model is not sustainable, there is nothing you can do in 5 years. It's going to die because it's not sustainable, or it's not interesting because it's not sustainable. But we don't have the ambition to change these business models. The ambition is to identify business models as they have a positive environmental impact and help them grow faster, bigger, and more international so that they fight the bad guys with us.
So is it sequential for you, or do you first do a screen with sustainability and then ESG?
No, we do. The first thing we do is we check sustainability because in private equity, I don't know how much it's visible from outside the industry, but really the bottleneck is your time, people, is not the capital you have. You always have more capital than is written in the books because if you find an incredible investment, you go to your investors, they give you all the money you want to do a much bigger investment. The problem is not the money. The problem is to find the investments. The problem is your own internal resources, is the people you can mobilize and the people that you have. So you don't want to waste a minute on an investment you cannot do because it's not environmental. So the first thing we do is we make we convince ourselves that a certain business is an environmentally positive proposition. We go and we measure how environmentally positive it is. And if it passes our internal barriers, we say, okay, let's try to put a non-binding offer. Let's try to do some due diligence. Let's try to talk to somebody in the industry. But if we don't convince ourselves it's positively positive on environment, then we don't want to spend a minute. We just say, let's not waste time on this. It's not a business for us. ESG comes much later in the investment process. Once the investment is in proper formal due diligence, then we do an ESG due diligence. And the ESG due diligence will reveal certain situations, will reveal certain low-hanging fruits, will reveal certain risks and opportunities. We will then do a materiality analysis. We will then do an ESG action plan. We will implement it, etc., etc. But as I said, we are not going to ditch an investment because it's poor on ESG. We will improve it if it's poor. But sustainability is not improvable. If you do cigarettes and that's your business model, just to use a silly example, we don't have the ambition to buy a producer of tobacco and turn it in, I wouldn't know what, in 5 years. Because even if I knew what, it's probably not going to happen in 5 years, which is our average holding time.
A lot of professional investors like yourself have their own proprietary scoring, but everyone's trying to move the needle in a positive way regarding ESG and sustainability. Is that good, or would it be better to have a convergence? Because some argue that everybody having their own proprietary thing creates somewhat of a black box that's always subject to whatever your particular point of view is of what's good and what's helpful and what actually is sustainable. But then it can also lead to greenwashing or impact washing. Do you have a view on that?
Yeah, let's talk about sustainability. I think sustainability is more defined because I'm thinking as I speak. I mean, if a model doesn't have a positive environmental impact, like digging out coal, it's very difficult to argue that actually it does have a positive environmental impact. Because there is science, there is work, there is certain thinking that goes in a certain direction.
Yeah.
We don't manipulate the thinking. What we do with our methodology is not to create another thinking of ambientas, but we do simply measure the impact. So if we dig, for example, so much coal out of the planet and we burn it all, how much CO2 do you get when you burn a ton of this type of coal? Okay, so if we dig out this coal, and we know it's going to be burned because nobody eats it, this will have a negative, because it's negative, release of so many thousands tons of CO2. So we've quantified how negative that is. Conversely, if you invent a fuel, for example, that doesn't release CO2, now it doesn't exist, but for it as an example, then we would say, okay, this fuel offsets for each ton or for each caloric output of this fuel, offsets the equivalent caloric output of so many kilos of coal. They would have released so much CO2. So we quantify what is the CO2 saving of this new technology compared to an incumbent technology, like, for example, coal. I'm trying to keep it simple to give you some idea, right? So I think the sustainability is quite numerically defined and you can follow it. You just need to have a number of metrics that cover all sustainability. For example, the world very much has been insisting on CO2. And I certainly agree that CO2 is important, but CO2 is not everything. CO2 is certainly one. We have 11 environmental metrics that we use. So you have businesses where you save CO2 and you measure how much CO2 you save. Great. But then, for example, we have businesses where you clean water. So it's got nothing to do with CO2, but you take dirty water, you remove all the contaminants and you dispose of them accordingly, and you release to the system fresh, uncontaminated water. This is also a positive environmental impact, which has got nothing to do with CO2. Another one of our environmental metrics is biodiversity. You have certain business models that foster biodiversity. They have nothing to do with CO2, but they foster biodiversity, which is another environmental metrics. So we have 11 environmental metrics because we think that many you need to really cover all the aspects of what is an environmentally sustainable business. And that, I think, is our uniqueness. A lot of people does the same, but they only use CO2.
Would you be able to give me one example of a private equity investment you've made that you think represents the type of investment you prefer? And maybe you could walk me through how you made that, how you evaluated that, and then if it's something you've exited, what the result was or the impact that you achieved with that.
Sustainability, we're speaking, right? Not ESG.
Any investment that you made that you think really represents what you're doing in the private equity fund?
No, because we invest in sustainability, but we also invest in ESG. So sustainability, for example, we have an investment that produces additives for the cement industry. The cement industry is very much under the microscope because of its CO2 emissions. The cement industry has done a lot in terms of evolving their technological processes in order to save CO2, and they have achieved some results. Now, another thing you can do with cement is to blend cement, gray cement, with more intelligent binders. You need to have mixes that behave structurally better than cement. And thanks to this, you use less of it in terms of quantity and you use less cement. Now, to give you an extreme example, just to make it clear, if you think, for example, of sewage pipes can be made of cement, which is a fairly used technology because it's cheap. But then certain combinations of acidity and temperature, like you have often in Asia, they pit cement. And those pipes become all pitted, they start leaking black waters, which are not usually very environmentally friendly. You have to repair them, you've got to dig everything out, and you've got to redo them. Now, for example, if you use calcium aluminate cement, which is an additive for cement, and we own a company that does it, and you make them out of pure calcium aluminate cement, which nobody does because it's very expensive. Usually you blend it with cement. But just to make it extreme, then you would have a pipe that lasts, even under the most aggressive circumstances, over a century. There is lab tests, accelerated lab tests to prove that. So you would never have to dig a city out to repipe sewage. There you have an environmental impact. You don't have leakages of dirty waters. You don't have all the emissions that are associated to digging those pipes out, recasting them, and putting them down into the earth. This is probably an example of a type of sustainable business we like to invest. Or another one, sorry, I forgot this, even better. We invested in the European leader, already sold many years ago, the European leader of water-based pigments and coatings for wood. So you can coat your whatever wood with a solvent-based, solvent-carrier pigment, and then you will release a lot of aromatic compounds, which are usually toxic, if not, at least not cancerogenic. Or you can use water It's a different technology, it's more complicated, they are a bit more expensive. But now in Europe, the share of water-based colors, imagine IKEA, is almost 100%. But in Asia, it's still almost 0%, because in Asia, it's still prevailing, the cost is still prevailing over the environment.
How do you bring it down to measuring the impact your investment has?
Environmental impact, like for example, in the case of the coatings, we know in what application sectors we sell how many tons of what, and we know what other technology we are going to go displace with our sales. Yeah. So we know how many tons of what kind of solvent-based coloring systems we are going to replace. So we know that our product, for example, specifically in this case, our product was going on front coatings of wardrobe panels, as well on back coatings of wardrobe panels. You replace different kind of paints, because what you use for paint in the front is more glossy and usually more expensive than what you use for paint in the back. But we had product for both lines, and we knew what we competed against in terms of solvents. So we can calculate how many tons of solvents we eventually replace with all the tons of product that we invoice for. So it's a fairly precise calculation of what is the environmental impact. We can calculate how many tons of solvents we eliminated. We can also calculate the saving in terms of CO2, because solvent-based coating systems are heavier, so they have a higher transportation cost, because you have more solvent and less pigment. When you use water, you have more pigment and less water.
Do you feel that you can achieve this level of precision in calculating impact?
What we declare to our investors, first of all, the methodology we use is proprietary, but it's not secret. Our LPs have it. It's agreed upon together with them, so they are happy with the methodology. We told them very clearly that we are not a university, so our ambition is not to be perfect, but our ambition is to make sure we are not investing in greenwashing. So if I tell you I am doing incredibly environmentally friendly solvent-based coatings, we go measure and we say, well, actually they don't look that friendly, as much friendly as water-based. So our goal is not to be precise, but our goal is to be reasonably accurate in order to understand whether we are putting money into something which is environmentally positive. This is key for us, because only if we can prove this to our investors, they will convince themselves to recircle the money and refund us and others like us to continue investing in environmentally positive propositions.
I read in your 2019 report, or one published by Ambienta, and you were quoted, it said, Ambienta has always considered ESG as a value creation tool, and the secret lies in the creation of its own meticulous industrial approach, which goes far beyond a mere administrative box-ticking approach. What does that mean in practice? I
remember that sentence very well, that quote very well, and I think it captures my thinking very well. The examples I gave you is sustainability, but not necessarily ESG. Now, the quote you selected is ESG. So I mentally move from sustainability into ESG, which is a different thing. In ESG, what does it say? I mean, ESG basically comes out of the PRI, responsible investment directives or reasoning, where the reasoning is, if you're abusing of any of your input factors, you will pay the bill later. So if you abuse of your environment by misusing any environmental resource, you will have a bill to pay later in time. You abuse of your labor force and you don't return enough for what you take, or you do wrong things, you'll pay a bill at some time. And if you abuse your governance, if you abuse your stakeholders, and there is plenty of examples, some of which are famous, like female products, but in the board and in the management, there is not a single woman. If you abuse of your stakeholders, you take them for a ride, you'll pay a bill later. So this is the principle. So it's a fairly uncharted territory and pretty open. You can navigate north, south, east, or west. You can do, under such a broad philosophy, you can do a lot of things. So many LPs, in the rise of the awareness for ESG and in the hope to raise more capital, they started to create ESG denominated products. And they started to create an ESG strategy in order to justify the fact that they are an ESG denominated product. And as a strategy, very often they have picked, especially in public equity, but also in private equity, what I call tick the box. Do you have a responsible investment policy? Yeah, I do. Ticked. Do you measure the carbon emissions of yourself, the GP? Yeah, we do. Ticked. Do you have a diversity and inclusion policy? Yeah, I have. Ticked. Do you review it very often? Yeah, I review it every year. Okay, ticked. You are an good ESG fund. Actually, what do you know if I'm good or bad? I've said 4 very silly things.
Mm-hmm.
And I could simply say yes, yes, yes. What does it take to have a responsible investment policy? If you, as a bet, if you want, in 5 minutes with my pen, I'm going to write you one because I've seen a million of them. It takes nothing to have a responsible investment policy, and it means nothing to have a responsible investment policy. The trick is in the details. The devil is in the details. Then what do you do with this responsible investment policy? Now, when we go to ESG, for example, we have the famous ESG in Action program. So we have a booklet of about 60 pages, which I have developed internally, and it describes what the investment team needs to do with every new investment from the first day we own it, actually even before we own it, because it also covers what to do in due diligence, what analysis to do in due diligence, what to do when you own the company, how we organize ourselves vis-a-vis this company, how in terms of ESG, how we organize the company internally in terms of ESG. The company needs to adopt certain standards in terms of policies. Then the company needs to do a materiality analysis on risk and opportunity. The company needs to have an ESG action plan. It needs to be board approved. It needs to be reported to our investors. It needs to be followed up monthly by our investment team. And we also have an ESG audit function that audits on a monthly basis. It needs to be put in action. It needs to converge at the exit. When we exit the company, we do an audit and we go measure the gap between what we said we would have done and what we actually did. We also have a third-party auditor, PwC, that assesses the implementation, that assures the implementation of our ESG in action guidelines year by year on our portfolio companies. So we have a responsible investment policy, yes, but that's the box. You should ask me, what the hell do you do with this policy? Can you show me all the things that you do with this policy in terms of operating guidelines for your team and for your portfolio companies? And what results do you get to in the end? That, I think, is the question to ask, but it's more complicated. And then is also where it diverges. Because I can decide to focus on insurances because insurance is an element of governance. And I can say, well, I'm the wizard of insurance. Whenever I buy a company, I dig every possible risk out and I insure against. Perfect. It's not bad. Is it ESG? Yeah, it is ESG. Is it what I want? Well, maybe not, but it is ESG. And Ambienta prides itself of applying ESG primarily into industrial operations. So that is how to interpret that sentence. We are very active on environment because it's near our sustainability. And we are very active on governance because we are very keen on governance. And now I go back to value creation by means of ESG. For example, we have a company that we now sold several years ago. It was the first investment of Ambienta 2 called IPC, where we bought the company for a certain multiple because it was basically a federation of independent companies. We managed to create really a single company out of it. There was some synergies, but we only had it for 18 months. So we didn't even show at P&L level all the many synergies. But we created a single organization. We created divisions. We shaped the organization in order to feed the divisions. We created visibility on product profitability by single product family across countries so that you could monitor and exactly manage the ship in terms of strategy, because when we bought it, profitability by product and by country was impossible to track. We eliminated all the minorities. We eliminated all the litigation there was. Bottom line is we sold it 18 months later with more or less the same EBITDA. We bought it but at a double multiple. And the double multiple is because an industrial trade buyer, they looked at it before us when we bought it, dropped it because they said it's too complicated. We can't manage this mess. But the same industrial buyer, after we cleaned it, said, oh, now that he's a proper company, it's actually very complementary to what we do and we want to buy it. So by just working on ESG, we didn't really grow the EBITDA. We created a lot of value because we created something that was manageable.
So it sounds like you developed quite a lot of structure to hold your portfolio companies accountable for ESG. But do you have value add? Are you providing proactive technical assistance? Is that one of your key competitive advantages? You're not just holding them accountable, but you're also helping them find the keys to be accountable.
We help them in ESG and we also help them in operations. We have the investment team and then we have operating partners. The operating partners dive into the operations for our portfolio companies and help management to find what we are looking for, which is different company by company. Sometimes you look for output, sometimes you look for efficiency, sometimes There is another company, for example, a mini example of 1 minute. This company was doing componentry for tractors. And this company, so is a manufacturing company. So it's not a service company. The challenge was it needs to double again in 18 months. Now, doubling a manufacturing company is not easy. A service company, you sell more, but manufacturing, you've got to produce double the widgets that you sell. Yes, let's say that you have capex and you double the plant, but you can't do it in 18 months. And you double the workforce from 500 to 1,000, but you cannot recruit 500 people in 18 months. So how do you do that? And we needed the help of the entire organization working in a different way. So we went down to the single employee and we created a bonus system that included the entire firm, down to the single employee. We created WhatsApp groups where every shift was communicating the level of productivity to the incoming shift, so that the incoming shift knew whether they were starting from an advantage against budget or against production scheduling, or from a disadvantage, whether there was something to recover. We created an internal, for example, kindergarten for all the employees that had problems with children. They could bring them to work and we would take care of them in an internal kindergarten. In that case, the work was on S primarily, because we could only make our business plan by striking a pact with the workforce, with the total workforce, not just with the CEO and the CFO.
And who are your investors typically? And do they invest with you out of passion or because of returns or because of both, or does it not matter?
Our investors are the usual suspects, so our all institutional investors, fairly international. And as I was telling you at the beginning, about half, maybe a bit less than half, are investors that they run programs of sustainability. So they are thematic investors, but a bit more than half, they're actually generalists that are only interested in the returns. Now, in Ambienta 4, which we will probably be raising at some point in the future, because we are 3 years into Ambienta 3, I think this will change because all the generalists, though they may probably remain generalists, they are become ESG activists. So we will have a golden moment for ourselves where we will be able to sell our sustainability credentials as we did before for those who are interested in sustainability, but now we will be able to sell our ESG credentials to a general public that becomes more and more ESG conscious, even if they've got nothing to do with sustainability.
You constantly draw a very big, strict line between sustainability, ESG, but it's always one fund, right? It's one fund theory, and you're doing this sequentially, right?
Yeah, but it's not necessarily the same. If we, for example, had a financial service fund, it's got not really much to do with sustainability, with environmental impact. But you can run financial services being incredibly ESG active or being totally ESG ignorant or not care at all about ESG, right? Because in financial services, so you can score very high on ESG running financial services. Conversely, you can have a sustainability fund, thematic fund, environmental sustainability, and not pay any attention to ESG. Maybe I'm very interested in new technology to save CO2, but I don't care about governance. I don't care about social, right? So they're not necessarily the same thing. You could decouple them, and I think you should. We do. And manage them differently because they require two different things that your organization needs to do. And ESG is actually quite tricky in terms of organization because the investment team is constantly in a conflict where they're always short of time. And do I spend my hour on ESG or do I spend my hour on finding a new deal? And of course, the system is totally targeted to new deals. So we had to fight to challenge this and create attention for ESG. For example, all our bonuses from the lowest level in the organization to partners have an ESG dimension attached to it. If your companies don't do their ESG plan, you will have less bonus at the end of the year. Despite they are returning great and you've done 3 deals in 12 months, which is a superstar performance. But I am sorry, ESG wasn't there. You get a diminished bonus. And that is a big shift. Because deal makers don't want to deal with ESG. They want to do deals.
The explosion in interest in sustainable investments in these last years, which has resulted in high growth and capital flows into the space. Do you see a risk of an asset bubble given the amount of the capital flowing into limited sustainable opportunities?
I think there is in the same way there is on the market of companies we buy. I mean, there is greenwashing again. So I think LPs are trying to become smarter and figure out who is really doing something and who is actually just talking about it. And that goes back to the tick the box approach.
How do you protect yourself against this?
By always trying to be ahead of the others. Our ESG in Action program is improved every year. For example, the ambition is to start to have a CO2 budget for a few of our portfolio companies. So not only know their CO2 footprint, but also have a budget to make sure we know and we actually manage their CO2 growth. That would be fantastic if we can do it. I don't think anybody does it in the industry. 2 years ago, we had PwC assure the application of our ESG methodology, which to the extent I know from other sources, nobody is having really a third-party assurance, one of the big four assuring their application of ESG procedures. We report ESG progress quarterly to our LPs. I think we are the only one. Somebody doesn't report, somebody reports annually, we report quarterly. So every single piece of ESG that is implemented in each one of our companies gets reported on a quarterly basis. Of course, we also report the KPIs every year because some LPs love aggregating KPIs, et cetera, et cetera. We do that. But we report on a quarterly basis about anything that managerially is ESG relevant.
Do you have a view on what impact technology will have on sustainability and what impact will sustainability have on technology?
We just written a perspective. I mean, we publish every 6 months something which we call Ambienta Lens. It was actually discussing the impact of technology on sustainability. And of course, the understanding and the imagination is, yes, technology is going to be positive. And this is probably 90% true. There is exceptions. And again, it's important to have an analytical frame to figure out what are the exceptions so that you don't fall into the exceptions. The team of 6 people in our Milan office, the research, tries to understand the impact of sustainability on sectors. And so far in 15 years, they've dug into 45 sectors. We have a book of sectors that we maintain internally, which is our core knowledge. And the sustainability team has a meeting every month with the investment team, and they sort of teach them about new perspective, new findings, new ideas. And this material is also condensed in these Ambienta lenses, which are then sent to investors, to whoever is interested.
If you had to name the single most important challenge in the sustainable investment space at this time, what would it be?
Well, I see greenwashing clearly. I mean, people invent entirely without any base green propositions that don't make any sense.
It's not an unusual answer.
I was just thinking it's not very innovative, but that's really the
it's probably the most common answer. Let me ask you another one now. What do you know now about sustainable investing that you wish you knew in 2012 when you showed up at Ambienta?
I think the rigor of the approach is the most important thing. You need to have a methodology that you apply in what you do that is shared with investors, because you need to bring the investors in the journey together with you. Where I think Ambienta has been successful against other funds that started and didn't complete the journey is that we were able to continuously communicate with our investors and bring them along in a journey where we have discovered a number of things and they have discovered them together with us. We, for example, ditched investments that they loved because they were good investments, but because we could prove ourselves and prove also themselves that we're not environmentally sustainable. For example, in palm oil, very debatable. In terms of resource efficiency, palm oil is great. It's the best edible fat at the cheapest possible price. But in terms of biodiversity, it's going to kill the planet. We decided not to invest in palm oil, and we had to prove it to them with, work.
And back when you came in Ambienta in 2012, was there something that you thought was really important, but now you know it's not?
Well, in terms of sustainability, discipline methodology, I think is the key finding. And if you allow me to mix sustainability with ESG, especially internally, the discipline, the accountability to bring ESG and sustainability in the mind of deal makers. Like bankers, they think about, this deal, I can do it. How much money am I going to make it? What's my carried interest? Okay, go, press the button, do it. And instead we have to say, no, wait, let's see if we can do it. Let's see if we want to do it. Let's see if our investors believe in it.
You don't have to name names, but can you describe to me an example of a deal or an investment you made that you were convinced at the time you made it, it ticked all your boxes, it met all your methodologies, but in the end, it didn't turn out at all like what you expected? It was disappointing. And what did you learn from that? Well,
I mean, like in any fund, you've got some economic disappointments from time to time, which is not related to sustainability, though usually is more related to our investment strategy is usually quite transformative, because imagine that 90% of our deals are primary deals. So we buy 90% of our companies, we buy them from entrepreneurs. So they are under-managed, they are usually under-analyzed, they are non-numeric. So we need to bring numeracy to these companies, we need to bring processes to this company, we need to bring management, we need to bring change. Mm-hmm. So that doesn't always happen. I mean, most of the time it happens, but there is a couple of examples where it didn't happen. And that goes back to the majority and minority. It's way more difficult where you're in a minority position, and when the entrepreneur is still probably in a majority position, then you can't really change somebody that was unable to change for 50 years of his life, and then he tells you, I'm going to change now, and you make a plan, but then he's not going to change it.
So your lesson learned is probably to have a majority.
Certainly the majority is a lesson learned.
Now, what about the converse of that? Have you ever made an investment that at the time you were skeptical, or that you even passed on it and it actually turned out way better than you thought and you were glad you invested, or you regretted that you didn't invest?
Now, talking about ESG, which is not necessarily returns, but it's a different kind of happiness, I can tell you that we figured out that there is an enormous correlation between the quality of management and the level of implementation of ESG issues or ESG management actions. It requires a competent team to manage ESG because it's not easy. Mm-hmm. Usually, if the team is less competent, they really struggle with ESG. They are always late. They are always superficial. They usually don't get it right at the first time. And sometimes they don't even understand why they have to do it. Once you have changed, usually, or upgraded the management team and it's more complete, it's got bigger broadband, and then they understand why they have to do it. Usually in good companies, because if the management team is good, usually the company performs well in terms of growth. For example, now we have a company that is growing incredibly well. We have a company which is a little DocuSign. The part of digital transaction is growing organic at 80%. For example, the management came and told us, why don't we become a B Corp? And I said, well, that's very ambitious and that's very good. Ambienta is a B Corp. We will certainly support you to become a B Corp. We've never asked any of our portfolio companies. Yeah, we ask them to improve, but not to become a B Corp. But they want to, out of their own desire, become a B Corp because he sees a lot of implications, positive implications of possibly one day being a B Corp. So good teams are very good on ESG. Bad teams struggle with the business and struggle with ESG.
If someone wants to get into the sustainable investing space, probably talking to someone who is less experienced than you and I, meaning someone younger, how would you advise them to get in the business? Where's the best place for them to start or cut their teeth?
I'm 60 years old and I've been in consulting and I've been in investing. And what I think remains the most precious ingredient to really make this passion. Person that wants to make a change in sustainability or in ESG needs to feel it. It needs to do it not for the money, but for passion, because they really want to do something that maybe already exists much better. Think about packaging. How much packaging do you waste every week? I am the one who takes the recycling bin outside every week. I can tell you, though in my house, everybody knows about recycling. Every time I take the bin out, I say, why do we have this mountain of stuff? And every single packaging, actually, you think, why did they think it like this? Why don't they use monomaterial? Why don't they use thinner layers? Why don't they wrap differently? If you have passion, you can find your own sustainability in many things. Once, when I was in MIT, I did a course of innovation. And one of the questions of the students to the professor was, but innovation is not easy. It's called innovation because it's rare, right? So, what do we do? It's like chasing, how do you say in English, throwing a needle in a... And the guy said, not at all. Pick any object, your pen, your whatever, headphones. It can be done better. Just think about it, and it can be done better. And the same is with sustainability. Pick whatever you have in your hands and think, is this really sustainable? Is this optimized for sustainability? And this could be an object or could be a company. And you need to have the passion, usually of a youngster, to say, I'm now going to change this and make it much better. This is the most important thing that I think you need to have. If you accept the status quo and you only think about the returns, then, just miss the opportunity.
I got it written down, passion. So, listen, Stefano, this has been very interesting. Thank you very much for your time.
A pleasure.
It's been a great pleasure to meet you. I enjoyed it.
Likewise. Thank you very much.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.